So at 10 in the morning, on May 7th, 2026, if you were sitting there holding an S&P 500 index fund, you were basically staring at the highest valuation in human
Oh,
history.
absolutely. I mean, it was historically unprecedented.
Right. The index was sitting at 7,385.02. I
Yeah.
mean, the champagne was effectively already poured, right? People were celebrating.
That felt like a total victory lap for the bulls.
Exactly. But then, by 4 p.m., the algorithms were just aggressively dumping technology equities. The Russell 2000 was in absolute free fall, and literally billions of dollars in market value had just simply evaporated into thin air.
It was a violent reversal.
Yeah.
Yeah.
So today, we are doing a deep dive. We're opening up the exact high-frequency data, the corporate earnings call transcripts, and the geopolitical intelligence reports that actually triggered one of the most violent intraday market whiplashes of this entire decade.
And well, what's fascinating here is that the speed of that reversal, it really tells us we are no longer dealing with standard business cycle volatility. Like, this isn't normal.
No, not at all.
The price action on May 7th exposed this profound, really structural tug of war. Because on one side, you have the transformational, almost utopian promise of the artificial intelligence super cycle, right?
Right, this immense capital expenditure supercycle promising, exponential productivity.
Exactly. But pulling violently on the exact opposite end of that rope is the restrictive, gritty, physical reality of a kinetic energy war in the Middle East. It is this massive collision between boundless digital expansion and hard physical constraints.
And we have a massive stack of sources today to help you navigate exactly this. I mean, from secondary sanction reports out of the U.S. Treasury all the way to domestic labor statistics, we're going to decode a global economy that is frankly caught in severe cognitive dissonance.
Severe cognitive dissonance is probably the best way to describe it, honestly.
Yeah, we are cutting through the AI hype and the geopolitical fog of war to give you the ultimate shortcut to understanding the actual mechanics of the world right now. Because, if you are just glancing at the daily closing numbers, you are driving completely blind. You're just looking at the paint job on a car with a blown engine.
Exactly. So let's look at the actual anatomy of this reversal. The S&P closed down 0.38%. The Nasdaq finished down 0.13%. The Dow slid 0.63%, and that was mainly dragged down by heavy industrials like Caterpillar and financials like Goldman Sachs.
Yeah, the heavyweights really felt the gravity in the afternoon.
They did. And then the Russell 2000, which is the index tracking smaller, domestically focused American companies, it took the hardest hit of all, dropping 1.71%. I mean, 9 out of 11 S&P sectors ended the day in the red, with energy just getting battered down 1.92%.
Right, and the mechanics behind that afternoon sell-off are incredibly revealing. Because, we saw heavy profit-taking precisely as the S&P hit technical resistance levels around that 7,380 mark.
But it wasn't just human traders taking chips off the table.
It rarely is these days.
Exactly. Modern equity markets are heavily dominated by systematic algorithmic trading strategies. So when the morning's geopolitical rumors of peace in the Middle East failed to materialize into actual signed memorandums by the afternoon,
The algorithms just panic.
well, they mechanically reacted. They registered a spike in the VIX, the volatility index, and they mechanically deleveraged. They withdrew liquidity from the market instantaneously, which is why that drop felt like a trapdoor just suddenly opening underneath everyone.
Okay, let's unpack this.
Yeah.
Because I look at that 1.71% drop in the Russell 2000, and I look at the major indices, and I just keep coming back to this idea of a hollow market.
The hollow market, I like that.
Yeah, it's like, okay, imagine a massive cargo freighter, right? And it has 490 individual compartments that are actively taking on water. But the 10 compartments at the very bow of the ship are filled with helium.
Right, the mega caps.
Exactly. So the ship is technically still floating higher, right? The headline number looks great, but the structural integrity of the vessel is completely compromised. So I guess my question is, if the average constituent of the S&P 500 is actually mired in a correction, are the major indices just lying to us? Is the pricing mechanism broken?
Well, the pricing mechanism isn't broken per se, but it is heavily distorted by market capitalization weighting. So, to put concrete numbers on your cargo freighter analogy, the semiconductor and semiconductor equipment sector alone has accounted for over 37% of the S&P 500's total market capitalization increase since the March lows.
37%, that is just staggering.
It is. When you buy a broad market index fund right now, you are no longer buying a diversified reflection of the broad American economy. You are overwhelmingly allocating capital into the artificial intelligence infrastructure build-out.
You're just buying the helium.
Exactly. And historically, when we see this kind of extreme divergence where a handful of mega cap companies mask the median stock falling, it usually precedes periods of severe systemic repricing. The Russell 2000 drop is basically the physical economy sending out a distress signal.
Okay, here's where it gets really interesting, because you can see this hollow rally perfectly reflected in the actual Q1 2026 corporate earnings season.
Oh, the bifurcation in the earnings calls is wild.
It's a stark bifurcation between the companies building the future data centers and the companies dealing with the miserable physical present. So let's start with the vanguard. Nvidia gained another 2.1% on May 7th, hitting a market cap of $5.05 trillion.
$5 trillion. It's hard to even wrap your head around that number.
And they reported a 73.2% year-over-year revenue increase to $68.13 billion, which was heavily fueled by their CEO, Jensen Huang, maintaining incredibly aggressive forward guidance.
Right. And the underlying mechanism driving NVIDIA's continued ascent is this massive transition from general-purpose computing to accelerated computing. Data centers globally are literally tearing out traditional CPUs and replacing them with highly specialized GPUs to train and run these massive large language models.
And Nvidia isn't just selling the physical chip, right?
No, not at all. They are selling the entire networking architecture and the software stack, the CEDA platform that binds all those chips together. Their moat is currently perceived as totally impenetrable, which is exactly why the market is willing to assign them a valuation that eclipses the GDP of most developed nations.
But, even within the tech sector, that helium isn't lifting every single boat.
That's a great point.
Look at AMD. They slid 2% on profit-taking despite a massive 18.6% surge earlier in the week. And then there is ARM Holdings. ARM actually beat their earnings estimates on both the top and bottom lines, yet their stock plummeted 10% in a single session.
10% on an earnings beat is brutal.
Right. I look at that and think the narrative of a smartphone plateau isn't enough to justify a 10% haircut. It seems to me like the market is punishing them for the massive capital expenditure required to transition from, merely licensing their architecture to actually designing and testing custom silicon.
That is precisely the mechanism at play. For years, ARM operated on a highly lucrative, very asset-light business model. They designed the instruction sets, basically the architectural blueprints, and licensed them to companies like Apple or Qualcomm, and then just sat back and collected royalties.
Which is a great business to be in.
It's fantastic. But to capture more of the AI data center market, they are undertaking this incredibly capital-intensive process of developing complete compute subsystems. So investors are looking at the massive upfront R&D costs and the multi-year timeline to profitability for that custom silicon, and they are repricing the stock.
Because there's zero tolerance for that right now.
Exactly. In a market where valuations are this stretched, if your growth narrative introduces structural execution risk, institutional capital abandons you instantly.
And that zero tolerance policy is showing up in cybersecurity, too. We saw Datadog surge 33.6% after raising their guidance, pulling CrowdStrike and Palo Alto networks up in its wake. But conversely, Fastly crumbled 25% despite beating its estimates.
Yeah, the cybersecurity divergence is fascinating.
The Datadog surge makes complete sense when you look at the macro environment. With a kinetic conflict escalating in the Middle East, corporate boards are absolutely terrified of state-sponsored cyber retaliation. It creates this inelastic demand for digital observability and endpoint security. They're panic buying protection.
Well, the cybersecurity sector operates on a threat-driven procurement cycle. When geopolitical tensions escalate, chief information security officers, they don't have to fight for budget approvals anymore.
The board just hands them a blank check.
Exactly. The board mandates immediate deployment of zero-trust architectures. So the companies providing comprehensive, platform-level security like Palo Alto networks are capturing that consolidated spend. But companies offering point solutions or those tied to lower-margin content delivery networks like Fastly are just being mercilessly filtered out by the market.
So we have this ruthless filtering mechanism in tech. But if you step outside of that digital bubble and look at the physical economy, the narrative is just grim. I call this the mid-tier tap-out.
The mid-tier tap-out?
Yeah, let's look at Whirlpool. Their shares were absolutely decimated, down roughly 13%. They were forced to cut their dividend, citing severe supply chain bottlenecks. And this specific term they kept using on the earnings call, a quote-unquote plastic shock.
Right, the plastic shock.
What exactly is that?
So, the mechanics of a plastic shock are a perfect illustration of how geopolitical instability trickles all the way down to domestic manufacturing. Because, the vast majority of industrial plastics, the resins, polyurethanes, and polypropylenes used to mold the interior of a refrigerator or the drum of a washing machine, they are derived directly from petrochemicals.
So it all comes back to oil.
Specifically from naphtha cracking, which is a byproduct of crude oil refining. So when global crude prices experience massive sustained volatility, the input costs for those raw resins skyrocket. Whirlpool is locked into forward contracts for these materials. When those contracts expire and reset at, say, 40% higher prices, it instantly incinerates their operating margins.
Wow. And they can't just absorb that cost, obviously. They have to accelerate pricing actions to protect their margins, which means passing that cost directly onto a consumer base that is already totally exhausted.
The consumer is definitely feeling the squeeze.
We see the exact same exhaustion playing out in the restaurant sector, right? Shake Shack lost 22% of its value, explicitly blaming a challenging macro environment. But on the exact same day, DoorDash gains 3%.
Yeah, that divergence is so telling.
I'm trying to square that.
Hmm.
Because you have upper-income households who can easily absorb a $7 delivery fee on a Tuesday night for their takeout. But the traditional middle-class consumer is actively rotating away from an $18 fast casual burger. The elasticity of demand has completely snapped for the median earner.
Well, if we connect this to the bigger picture, you are describing the stark realities of an energy-driven inflationary environment. Elevated energy prices act as a highly regressive tax.
Meaning it hurts the lower earners way more.
Exactly. A household in the top decile of income earners might spend, let's say, 3% of their take-home pay on gasoline and utilities. A household in the bottom quartile might spend 20%.
Yeah.
So when oil prices surge, the disposable discretionary income of the middle and lower classes is functionally destroyed. They engage in defensive consumption, they trade down from a Shake Shack to just eating at home, or they delay the purchase of a new Whirlpool appliance entirely.
Which directly forces our attention to the primary catalyst of all of this. Because to understand why the consumer is tapped out, to understand the mechanics of Whirlpool's plastic shock, and to decode the massive market reversal on May 7th, we have to look at the global energy choke point.
The Middle East.
Yes. The entire morning rally in the stock market was predicated on a specific geopolitical rumor regarding the Middle East.
The market was basically attempting to price in the removal of the volatility tax.
Exactly. Axios published a report early that morning suggesting the U.S. and Iran were close to a breakthrough peace deal mediated by back channels in Pakistan. The core objective of this agreement was reopening the Strait of Hormuz for normalized commercial shipping.
And the algorithms loved that.
The algorithmic response was instantaneous. Brent crude tumbled below $100 a barrel, closing at $97.43, and West Texas Intermediate was heading rapidly toward a $90 floor. For a few hours, the market believed the supply shock was just over.
But the mechanics of international diplomacy rarely match the speed of financial markets. I mean, by the afternoon, the probability of that memorandum holding had completely collapsed.
It fell apart so fast.
It did. The Iranian Foreign Ministry issued a statement asserting that no conclusion had been reached, and President Trump publicly warned that the agreement was, quote, not certain.
And the physical reality on the water completely contradicted the diplomatic rumors anyway. While the market was pricing in peace, we had confirmed reports of a U.S. fighter jet actively disabling the rudder of an Iranian oil tanker in the Gulf of Oman just to enforce the blockade.
Which is a huge deal.
Plus, simultaneously, Israel carried out coordinated strikes in Beirut and Gaza City. It just highlights how utterly intractable this regional complexity is. The diplomacy is basically a smokescreen for ongoing kinetic operations.
Let's examine the mechanics of that tanker incident for a second, because it explains why the oil markets remain so elevated despite the peace rumors. Disabling a rudder from the air is a highly precise, highly escalatory tactic. It's designed to paralyze a vessel without sinking it or causing an environmental disaster.
Right, you don't want an oil spill, but you want to stop the ship.
Precisely. But the message it sends to the global maritime insurance industry is profound. When Lloyd's of London and other major syndicates assess the war risk premiums for vessels transiting the Persian Gulf, incidents like this cause those premiums to skyrocket by hundreds of thousands of dollars per voyage.
Wow.
Yeah. And even if a ceasefire were signed tomorrow, the insurance syndicates will not immediately lower those rates. They need months of proven safety before they adjust.
Which means the cost of transporting a barrel of oil remains structurally higher. regardless of what a piece of paper says in a peace treaty. So I have to ask you, if peace actually happens, does oil ever return to its pre-war baseline? Or is the market signaling that this maritime volatility tax is just a permanent fixture of the new global economy?
Well, the market is unequivocally pricing in a prolonged structural shift. We are essentially witnessing the end of the hyper-optimized, just-in-time global energy delivery system that basically dominated the post-Cold War era.
The era of cheap, easy shipping is over.
It is. We are transitioning into a world of deeply fractured, highly militarized supply chains. I mean, oil is still up nearly 80% since the beginning of 2026. The baseline price of energy has been permanently recalibrated upward, which fundamentally shifts all global inflation models.
And this energy conflict is not geographically contained either. The secondary shockwaves of how we enforce these blockades are radiating outward, and they're directly triggering the next massive geopolitical flashpoint, the upcoming May 14th to 15th summit between the United States and China in Beijing.
Because Iranian oil and Chinese financial institutions are deeply intertwined.
They are completely enmeshed.
Yeah, to understand the stakes of the Trump-Xi summit, you really must understand the mechanics of secondary sanctions.
Let's lay out the exact plumbing of this for the listener because it's crucial. U.S. Treasury Secretary Scott Bessent sent formal warning letters to the executive boards of major Chinese banks. The directive was completely unambiguous. If your institution continues to provide financial clearing services or letters of credit to private Chinese refiners, the so-called teapots, who are purchasing sanctioned Iranian crude oil, the U.S. Treasury will deploy secondary sanctions.
And China didn't just take that lying down.
No, China retaliated immediately.
Yeah.
They instructed major state-owned banks to temporarily halt all fresh lending to those targeted domestic refineries.
The mechanism of a secondary sanction is basically the most powerful non-kinetic weapon in the U.S. arsenal.
How does it actually work in practice?
Well, it relies entirely on the dominance of the U.S. dollar in global trade. If the Treasury places a Chinese bank on the SDN list, the Specially Designated Nationals list, that bank is completely severed from the Chi-Chia-PS network, the clearinghouse interbank payment system.
Meaning they can't touch dollars.
Exactly. It means that bank can no longer process transactions in U.S. dollars. For a major Chinese commercial bank, losing access to dollar clearing is effectively a death sentence for their international business operations.
So the U.S. is holding the ultimate financial trump card. But China isn't walking into this summit empty-handed either. They are holding the physical trump card.
Right, the rare earths.
Yes. China currently controls roughly 90% of the global refining capacity for rare earth minerals. They process nearly all of the heavy rare earth elements, like dysprosium and terbium. So the U.S. threatens to cut off China's access to the dollar, and China can simply counter by restricting export licenses for the exact critical minerals that Nvidia, Apple, and Tesla require to manufacture their hardware.
And the vulnerability on the American side there is incredibly acute, because mining rare earths is not the actual bottleneck. The bottleneck is the incredibly complex, highly toxic metallurgical process required to separate and refine these elements into usable oxides and metals.
Which we just don't do at scale domestically.
We don't. The U.S. government's internal modeling estimates that a mere 10% disruption in the supply of processed rare earths from China could trigger $150 billion in global economic losses within a single year.
A 10% drop causes $150 billion in losses.
Easily. It would paralyze the semiconductor supply chain, halt the production of high-performance EV motors, and severely degrade defense manufacturing capabilities. Building domestic refining capacity takes years of environmental permitting and billions in capital expenditure, and China knows this.
This is why the Beijing summit is so critical. Both President Trump and President Xi are navigating incredibly complex domestic economic pressures, and both need a strategic win. But beyond the immediate leverage of dollar clearing versus rare earths, they're also sitting down to discuss a totally unprecedented topic for a bilateral summit.
Advanced AI safety protocol.
Right. The sources specifically cite the emergence of Anthropic's new Mythos model as the catalyst forcing them to the table.
The inclusion of AI safety at this level of diplomacy is historic. When we talk about models like Mythos, we are no longer discussing, text generation or customer service chatbots.
No, we're way past that.
We are talking about advanced multimodal reasoning engines capable of synthesizing complex chemical formulations or identifying vulnerabilities in critical infrastructure code. Both Washington and Beijing recognize that the proliferation of an unaligned model could empower non-state actors with the capabilities of a nation-state.
Specifically regarding cyber warfare and the design of biological weapons?
Exactly. They are attempting to establish a red phone protocol for digital proliferation before a catastrophic event literally forces their hand.
It's fascinating, honestly, that the two most powerful geopolitical rivals are simultaneously threatening each other with economic ruin while also trying to build guardrails to ensure a rogue algorithm doesn't wipe them both out.
It is a massive paradox.
It really is.
Yeah.
But amidst all this high-level tech and finance tension, the sources highlighted a shift in the agricultural sector that absolutely blew my mind. U.S. soybean sales to China have just hit a marketing year low. China is actively choosing to bypass American farmers and import cheaper soybeans from Brazil.
Which sounds terrible at first glance.
Right. On paper, that looks like a devastating blow to U.S. agriculture.
Well, on the surface, it appears to be a massive loss of leverage for the American farmer. Because historically, agricultural exports were the primary U.S. bargaining chip in trade negotiations with Beijing. But there is a vital mechanical shift occurring underneath the headline export numbers.
The domestic crush.
Yes. While export demand has plummeted, the U.S. domestic crush rate, which is the volume of soybeans physically processed within the United States to extract oil and soybean meal, has expanded to a record 61.2% of total demand.
And what exactly is driving that domestic demand? Because, Americans aren't suddenly eating 60% more tofu.
They certainly are not. It is driven by massive domestic industrial policy, specifically the renewable diesel mandate.
Okay, unpack that for us.
So federal and state level environmental regulations, particularly in places like California, have created massive tax incentives and compliance markets for renewable diesel. Now, unlike traditional biodiesel, renewable diesel is chemically identical to petroleum diesel, and it can be used in existing infrastructure without blending limits.
So you can just put it right in the tank of an 18-wheeler.
Exactly. To meet this mandated demand, energy companies have built massive refining facilities that require immense quantities of soybean oil as feedstock.
So we are quietly insulating our agricultural sector from global trade shocks by turning our soybean surplus into a domestic energy source.
We're consuming our own supply.
Right. The U.S. is essentially building internal resilience so that when China threatens to stop buying our beans, the economic impact is just muted.
Precisely. It fundamentally alters the calculus of the U.S.-China trade dynamic.
So let's tie these massive macro forces back to the ground level. We have an AI infrastructure boon absorbing trillions in capital, a consumer squeeze by elevated energy costs, and a massive geopolitical standoff over the physical supply chain. All of this tension inevitably trickles down to the domestic labor market.
It always does.
And when we look at the employment data from our sources, the numbers seem to be violently contradicting each other.
Yeah, the Treasury Department refers to this current state as a fragile equilibrium because the labor market is emitting entirely conflicting signals depending on which specific metric you happen to examine.
Let's lay out the contradiction. On one hand, U.S. initial jobless claims just rose to 200,000. Now, while that represents an uptick, it was actually lower than consensus expectations. Furthermore, the 4-week moving average for jobless claims dropped to 203,250. Which is the lowest level in over 2 years.
Right, which looks incredibly strong.
It does. And ADP reported that private payrolls jumped by 109,000 in April, hitting a 15-month high. If you look purely at those numbers, the labor market is historically tight. It looks like a phenomenal environment for the American worker.
But then you must incorporate the productivity metrics and the corporate layoff announcements to see the full picture. Preliminary Q1 productivity grew at a meager 0.8%, missing the 1.0% expectation.
That's a huge miss.
It is. And simultaneously, unit labor costs increased by 2.3%. And most alarmingly, the Challenger, Gray, and Christmas report showed that employers announced 83,390 job cuts in April alone, marking a 3-month high.
And tech was leading that, right?
The technology sector absolutely led those cuts, and for the second consecutive month, corporations explicitly cited quote-unquote artificial intelligence as the primary driver for the layoffs. They actually had a quote in there saying, regardless of whether individual jobs are being replaced by AI, the money for those roles is.
So what does this all mean? I need you to help me interpret this data because my initial instinct is to assume that corporate executives are simply lying.
Lying about the AI aspect.
Yeah. Are CEOs just using AI as a convenient scapegoat to fire middle management and appease Wall Street analysts who want to hear the buzzword? Or is this actually structural displacement? And more importantly, if 83,000 people are getting fired in a month, how on earth are overall jobless claims sitting at a 2-year low?
That is the defining question of the current domestic economy. To understand this, we have to look at the mechanics of the job ladder and intersector labor mobility.
Okay, the job ladder.
Right. When a major technology firm lays off a cohort of software engineers or project managers, those individuals possess highly desirable, transferable skills. They are not filing for long-term unemployment benefits.
Since they don't need to.
Exactly. They are being rapidly absorbed by other sectors of the economy that are currently starving for talent.
Right, because every traditional company is now trying to build out their own digital infrastructure.
Exactly. The displaced tech worker from Silicon Valley is getting hired by a logistics firm in Ohio, upgrading its supply chain algorithms, or a renewable diesel plant in Iowa, optimizing its continuous flow processing.
That makes total sense.
The job losses in the hypergrowth tech sector are being immediately offset by hiring in domestic manufacturing, infrastructure, and healthcare. This constant churning keeps the aggregate initial jobless claims historically low.
Okay, so the rapid reabsorption explains the low jobless claims. But it doesn't explain the dismal 0.8% productivity growth.
Ah, right.
Because if these highly skilled workers are permeating the broader economy and companies are spending billions on AI tools to make everything faster and cheaper, why is actual economic output per hour worked completely stagnating?
Because of the massive friction inherent in integrating new technology, we are currently in the deployment phase of the AI supercycle, not the realization phase.
Meaning we're buying the tools, but we don't know how to use them yet.
Well, sort of. A company might spend millions licensing enterprise AI software and hiring engineers to implement it, but those engineers spend their first year just cleaning up legacy data silos and trying to make the new algorithms interface with 20-year-old back-end systems.
Oh, wow. Yeah.
The capital is being spent, the wages are being paid, but the corresponding exponential leap in widgets produced or services rendered has not yet materialized.
That makes perfect sense. They are building the factory, but the assembly line isn't running at full speed yet. But that creates a terrifying math problem for businesses, right? Because they are paying higher wages to retain these workers in an inflationary environment where oil is elevated, but those workers aren't producing more output to offset the higher pay.
That is the exact mathematical definition of wage push inflation.
Wage push inflation.
Yes. If a firm increases its aggregate payroll by 4% to attract talent, but the output per worker only increases by 0.8%, the unit labor cost surges. The only mechanism the firm has to protect its operating margins is to raise the final price of its goods or services.
This is precisely the dynamic forcing Whirlpool to accelerate pricing actions.
Exactly, it all connects.
Which brings us to the ultimate nightmare scenario for the people tasked with managing the global money supply, the central banks.
Yeah, they're in a very tough spot right now.
They are staring at a dashboard, flashing red across the board. Sticky wage push inflation, a labor market that refuses to loosen, and geopolitical supply shocks keeping energy prices permanently elevated. The Federal Reserve recently concluded its policy meeting and held the benchmark rate steady at 3.5 to 3.75%. But when you read the underlying communications, the consensus within the Fed is completely shattered.
No, we are witnessing the most fractured Federal Open Market Committee in recent history. The internal debate is no longer about fine-tuning. It is about fundamentally divergent views on the core threats to the economy.
Explain the divide.
Well, on one side, you have Governor Stephen Barron issuing a formal dissent, actively arguing that the Fed is suffocating capital investment and needs to cut rates immediately to prevent a manufacturing recession.
But then you have influential voices, like Minneapolis Fed President Neil Kashkari and Dallas Fed President Lori Logan, pushing aggressively in the opposite direction.
Right.
They are looking at the Strait of Hormuz, looking at the unit labor costs, and they are objecting to even the inclusion of an easing bias in the Fed's forward guidance. They are terrified that if the Fed signals rates are coming down, financial conditions will loosen prematurely and inflation will violently reaccelerate back toward 5%.
And as a result of this internal paralysis, the bond market has completely capitulated on its earlier assumptions. Expectations for a series of rate cuts in 2026 have effectively collapsed.
We're stuck here.
We are settling into a higher-for-longer regime. And this dynamic is playing out globally, too. The Bank of England and the European Central Bank both held their respective rates steady as well.
The ECB situation is particularly grim. They had to officially revise their 2026 inflation forecast upward to 2.6%, while simultaneously slashing their economic growth forecast down to a mere 0.9%.
That is the textbook definition of stagflation.
The economy is barely crawling, but prices are still rising. It's the worst of both worlds. However, amidst all these rate debates, our sources highlighted a much deeper existential threat emerging for these institutions.
The structural threat to central bank independence.
Right. The Group of 30, an extremely influential consultative body chaired by former NY Fed President William C. Dudley, released a comprehensive report urging the Federal Reserve to aggressively protect itself from political attacks and the emerging reality of fiscal dominance.
Fiscal dominance.
Yes, and at the same time, ECB Executive Board member Isabel Schnabel delivered a lecture explicitly warning that political interference risks completely unanchoring long-term public inflation expectations.
This raises an important question because fiscal dominance is an academic term that most people don't fully grasp until the consequences literally arrive at their doorstep. We need to clearly define the mechanics of how this destroys purchasing power.
Please walk us through exactly how fiscal dominance operates in reality, because it sounds ominous.
It is ominous. The standard model of a developed economy assumes monetary dominance, meaning the central bank sets interest rates purely based on the mandate to control inflation and maximize employment, completely independent of the government's spending habits.
Right. They act objectively.
Exactly. If the government runs a deficit, they issue bonds, and the free market dictates the yield required to buy that debt. But fiscal dominance occurs when a sovereign government's accumulated debt becomes so massive and their ongoing deficit spending so reckless that the interest payments on that debt threaten to consume the entire national budget.
In other words, if the Fed keeps rates at 4% or raises them to 5% to fight inflation, the U.S. Treasury literally cannot afford to pay the interest on its own bonds without defaulting.
Exactly. Under fiscal dominance, the central bank is effectively conquered by the Treasury.
Conquered? Wow.
Yeah, the central bank is forced to artificially suppress interest rates, keeping them lower than inflation dictates, solely to ensure the government can continue to service its debt. They monetize the debt by expanding their balance sheet to buy the bonds the market refuses to touch at those low yields.
So the central bank intentionally allows inflation to run hot, knowing it will erode the purchasing power of the average citizen simply to bail out the government's balance sheet.
Precisely. Inflation becomes a deliberate tool of state finance. This is why the G30 report is a flashing red siren. With figures like President Trump publicly demanding rate cuts regardless of the CPI data, the risk is that the public and the bond market realize the Fed is no longer fighting inflation, but rather facilitating government debt.
And once people realize that,
if that psychological shift occurs, inflation expectations become unanchored. Labor unions immediately demand 10% cost of living adjustments, corporations raise prices preemptively anticipating currency devaluation, and the cycle becomes entirely self-fulfilling.
And Kashkari is out there warning that if the energy shocks continue, the Fed might technically need to hike rates again to break the fever. If the Fed actually hiked rates right now, while the Treasury is issuing massive amounts of short-duration T-bills, it would be a financial earthquake.
Oh, absolutely.
It would shatter every assumption the market is currently trading on.
Which is precisely why we are observing such extreme, unprecedented price action in the alternative asset classes. When institutional capital realizes that fiat currency is structurally compromised by impending fiscal dominance, and that global equities are priced for an AI perfection that is being delayed by physical bottlenecks,
That capital aggressively seeks refuge.
it flows into systems completely outside the purview of the Treasury.
Which brings us to the everything else markets. The havens.
Yeah.
And the price action here is just fascinating. Let's look at the ancient safe haven first. Precious metals. Gold rose 1.6% to close at $4,768.20 an ounce.
It's an incredible run.
And silver surged an incredible 6.7% to break over $82 an ounce. We have major institutional analysts confidently projecting that gold will march toward $5,200 once the immediate noise of the geopolitical conflict subsides, driven purely by structural currency debasement.
The mechanics of the gold rally are highly illustrative. This isn't retail panic buying.
It's not just people hoarding coins.
No, this is sovereign wealth funds and foreign central banks aggressively accumulating physical gold to diversify their reserves away from U.S. dollar-denominated assets. When you witness the weaponization of the dollar clearing system through secondary sanctions, as we discussed with China,
The rest of the world takes notice.
exactly, non-aligned nations accelerate their de-dollarization efforts. Gold is the ultimate bearer asset with zero counterparty risk.
But then, on the completely opposite end of the technological spectrum, you have the modern haven, crypto. Bitcoin surged past the $80,000 level for the first time since January, marking a 26% rise from its recent lows. We saw massive inflows into spot exchange-traded products.
The ETF flows have been huge.
Right. I look at Bitcoin and gold in this environment, and they are such strange bedfellows. One is an ancient, heavy, tangible metal that empires have fought over for millennia. The other is an intangible string of code maintained by a decentralized network of computing nodes. Yet they are both absorbing the exact same geopolitical anxiety.
It is a remarkable convergence of narratives. Both assets offer an escape from discretionary monetary policy.
Yeah.
However, we must analyze the specific market mechanics underlying Bitcoin's recent move to 80,000. While the headline number is dramatic, the on-chain data and ETF flow analysis suggests the market might be experiencing a reversion to the mean, a normalization, rather than the ignition of a new, unrestrained, parabolic bull run.
Let's dig into that term, normalization. Because when I look at the data and the sources, it points to a very specific metric.
Right.
The average cost basis for investors who bought into the new spot ETFs earlier in the year is sitting right around $83,700.
That number is crucial.
When I see that number, I don't see a launch pad for a bull market. I see a massive psychological brick wall. If I'm a retail or institutional investor who bought the absolute top at $83,700 and I've spent the last 4 months bleeding out and questioning my life choices, the very second the price gets back to my break-even point,
You sell.
my overwhelming human instinct is to dump my bags. I sell, I take my original capital back, and I just walk away.
Your intuition aligns perfectly with the principles of behavioral finance. That 83,700 level represents an immense wall of overhead supply. It is an aggregate resistance zone formed by underwater investors seeking to be made whole.
So the current buying pressure is just going to hit that wall.
Exactly. The continuous inflows we are currently seeing into the ETFs are providing the buy-side liquidity necessary to push the price upward right now, but as it approaches that cost basis threshold, the selling pressure will increase exponentially. The market will have to absorb millions of dollars in distribution to clear that overhang before true price discovery can resume.
So the bulls have to chew through a massive layer of historical regret before they can push to new all-time highs.
Historical regret, that's exactly what it is.
But, regardless of the near-term price action, the macro trend is just undeniable. The U.S. dollar index actually fell on May 7th, even amidst a global market panic where investors typically flee to cash. Capital is actively seeking out jurisdictions with better interest rate differentials, or entirely abandoning fiat systems for hard assets like gold and decentralized networks like Bitcoin.
It all points back to a fundamental evaporation of trust in the institutions managing the money supply.
Let's bring this immense tapestry of information together. We have covered a massive amount of ground today. We started with the violent intraday whiplash of the S&P 500 and the Nasdaq, dissecting how the 37% concentration in semiconductors is masking a severe structural correction in the broader market.
Right. We analyzed the Q1 earnings bifurcation, where AI infrastructure giants like Nvidia continue to command astronomical valuations, while traditional manufacturers like Whirlpool are decimated by margin-crushing plastic shocks and a fundamentally exhausted middle-class consumer.
We mapped out the mechanics of the volatility tax, detailing how targeted military strikes on oil tanker rudders in the Gulf of Aden guarantee that global shipping insurance premiums, and consequently, energy inflation, remain permanently elevated, entirely independent of diplomatic rumors.
We traced the flow of secondary sanctions from the U.S. Treasury directly into the boardrooms of Chinese state-owned banks, establishing the incredibly high stakes for the Beijing summit, where access to dollar clearing will be weighed against the monopolistic control of the heavy rare earth refining process.
We looked at the quiet resilience of the U.S. agricultural sector pivoting to the renewable diesel mandate, and we debated the bizarre contradictions of a labor market where 83,000 tech workers are laid off due to AI, instantly absorbed by other sectors, only to produce a dismal 0.8% productivity growth rate.
All of which culminates in the crisis of central banking. The Federal Reserve and the ECB are paralyzed by wage push inflation and the looming threat of fiscal dominance, forcing global capital to flee into the divergent safe havens of physical gold and decentralized Bitcoin.
It is a dizzying amount of data to process. But if we distill all of this down, the near-term trajectory of the global economy hinges entirely on two impending binary events.
The first is the resolution of the Strait of Hormuz choke point. If the geopolitical backchannels miraculously succeed and a verifiable memorandum of understanding is signed and enforced, we will witness a violent mechanical repricing of energy markets.
A massive drop in oil.
Exactly. Crude oil will likely gap down toward $80 a barrel, immediately relieving margin pressure on industrial manufacturers and triggering a massive relief rally in transportation and consumer discretionary equities.
But it goes the other way.
Conversely, if kinetic escalation forces a total blockade, the risk of crude spiking to $130 becomes the dominant systemic threat, likely forcing central banks into emergency rate hikes.
The second binary event is the Beijing communique. The upcoming summit between President Trump and President Xi will dictate the physical supply chain for the next decade. They will either establish a codified trade truce, guaranteeing export licenses for critical minerals, and establishing baseline safety protocols for advanced AI models like Mythos.
Oh, they won't?
Right. Or they will trigger a devastating escalatory cycle of sanctions and export embargoes that will, frankly, paralyze the semiconductor industry. For you, listening to this deep dive, trying to manage your portfolio, build your business, or simply understand the reality of 2026, the overarching takeaway is that in this modern fog of war, volatility is the only true certainty.
The ground is constantly shifting.
The narrative
Yeah.
and the underlying data can violently flip in the span of an afternoon algorithmic trading session. You cannot rely on the headline numbers of the major indices to tell you the truth. You have to look at the structural forces operating beneath the surface. I want to leave you with one final provocative thought to ponder on your own.
Let's hear it.
We began this discussion by highlighting the profound collision between the digital realm and the physical world. Let's extrapolate that. Artificial intelligence is relentlessly championed as the ultimate deflationary mechanism in human history. It is engineered to write code instantly, optimize global logistics effortlessly, and replace millions of hours of human cognitive labor, thereby driving the cost of production towards zero.
Right, the deflationary promise.
But the physical reality required to power and build those AI models, the energy derived from contested shipping lanes, the rare earth minerals mined and refined under the threat of geopolitical embargo, the miles of copper wire, the billions of gallons of water for data center cooling, all of that is fundamentally and intensely inflationary.
It takes immense physical resources to run the cloud.
Exactly. So what happens when an infinitely scalable deflationary digital intelligence fully collides with the fiercely restricted inflationary constraints of the physical earth? Will the digital economy eventually engineer a way to detach entirely from physical constraints, perhaps through breakthroughs in material science or fusion, creating a self-sustaining virtual wealth loop? Or is a massive structural crash between these two diametrically opposed forces absolutely inevitable?
It is the defining economic and physical question of our generation. The answer will determine the trajectory of the next century.
Thank you so much for joining us on this deep dive. Keep reading the primary sources, keep interrogating the data beneath the surface, and always keep questioning the headlines. We'll catch you next time.